Hello, everyone. Welcome to our earnings call, August 2023. Thank you so much for joining. We're just going to give a few last minutes for people to continue joining, and then we'll kick off straight away. Okay, great. Let's go straight ahead. So great to have you today. My name's Corby Fine. I'm a general manager here at Adcore. Today we're going to be hearing from Omri Brill, CEO of Adcore, and Yatir Sadot, CFO of Adcore. Just to speak about the agenda, what we'll be covering today, starting off with some forward-looking statements, the CEO opening remarks, followed by CFO financial highlights, and finishing off with a brief Q&A. Please take a minute or two just to review the forward-looking statements and information. Great, thank you. And with that, I'm going to hand it over to Omri Brill, CEO of Adcore.
Great. So, good morning, everyone, and thank you, Kovi, for the intro. And we welcome everyone to the company Q2 2023 earnings call. And we have a strong report to present to you today, which obviously we're very proud of the performance of the company in Q2. And let me share my slides so we can get started. So, as I mentioned, Q2 2023 was a very strong quarter for us. It's marked a significant achievement and a positive growth for the company. And we're very proud of the results that we've been able to get. But actually, in this earnings call, before we dive deeper into the Q2 numbers, I would like to take this opportunity and basically discuss more high-level strategic opportunities for the company, as well on focusing on the long-term vision of the company, which obviously can lead us in the path of continued success. So usually we dive straight to the numbers, but we want to make this call a bit different and talk a bit in the beginning, high-level strategy and the way the company is based and what is it for the company, what the future holds for the company moving forward. So actually, I would like to start with some very interesting graphs that cover industry changes that we see in our industry, online advertising. And the first graph that I would like to share is basically demonstrate how both Google and Meta are basically losing dominance or market share within online advertising. And this graph actually covers everything from 2008 to 2024. And blue is the blue portion of the graph is Meta and Google share. And we can clearly see that it's peaked around 2016, 2017. But since it's peaked, that was the top of their market share, almost 50%. And then it's declined, starting to decline. And actually what we can also see, it's the rise of, let's say, competitor channels or competitor ad networks that wasn't existing back then. Competitors like TikTok, like Amazon advertising, like Apple advertising, for example, and many others. So the market becoming more complex, and that's not necessarily a bad thing for a company like Adcore. And the same story exactly that we see with Google and Meta, we see with regards to North America share with online advertising. So this graph actually going back to 2000 and until 2024. And again, North America, that's the blue portion of the graph. And we can clearly see that if in 2000, when it was still the early days of the internet, North America was representing 75% of online advertising globally. Then obviously fast forward, now we are talking about maybe 50%. So again, these emerging markets, emerging countries, and basically the market become more and more diverse. Yet again, it's not necessarily a bad thing for Adcore. So it's the same story whether we see it geographically or we see it with regards to ad network. More complex market, more competitors, and basically somebody that now is doing online advertising, his life is not as easy as it used to be, let's say, 10 years ago. And actually this graph actually tells the story quite well. So if in 2007 somebody would come to us and say, I would like to do online advertising, so probably we can recommend him to do Google, which had back then maybe like 50% of the market share of online advertising, and it can maybe only focus in US, which was still quite a large market by itself, and that was fine. So life was easy. He can do it by himself basically. And even in 2017, 10 years after that, still maybe not only Google, maybe Google and Facebook back then, but maybe it's enough. And now fast forward to 2023, we have so many channels, so many markets, and basically it's very complex for online advertisers to have relationship with every single channel and in every single market. So ideally, if they have somebody that sit in the middle, like a gateway, what Adcore is doing, that can be a very good news for them. And actually, it's also good news to the different channels as well. So only for the channels, the life is becoming more complex, and the channel ability to operate in any single market and every relationship with every single client is questionable. And that's why Adcore now holds very strategic partnership with many channels, whether it's Microsoft or Criteo and many others as well, because they need somebody, a company like Adcore, to sit in the middle and basically have the relationship with the customers from one end, and with the channel from other end, obviously have the technology and able to scale up the activity of everyone. Another thing that I would like to cover is how the company is accelerating. So everything it took us a long time to do before, now it's taking us a very short period of time relatively. And basically when I founded this business in 2006, we were still one office, not a lot of people in Tel Aviv, Israel. And it took us more than a decade until 2017, until we opened the first outpost outside of Tel Aviv, which was Melbourne, Australia. And then fast forward, after the company became a public company, geographic expansion was a major effort of the company. And what took us a decade between 2006 and 2017, literally took us 3 years to open another four different outposts. So after we went public, we opened the Hong Kong subsidiary, we opened the Shanghai subsidiary, obviously the Canadian Adcore Inc., which is, the public company. And in 2022, we also opened the US subsidiary. So whatever the company used to do for a long period of time. Now we can do much faster. And actually, we are quite pleased with the current geographical presence of the company. So we don't accept another, let's say, new outpost in the near future. We think that we should focus on what we have right now and making the most out of it. And the same story exactly as that we see with geographical expansion. Actually, it's funny, but we can see it with tech development as well. So in 2006, when the company just started, we launched our first version of our app, Adcore Views, for campaign creation and optimization. And it took us more than a decade until 2017 to launch our second app, which is Feeditor for feed optimization. And then, let's say, after going public, what we can see is that, again, it took us like 3 hours to launch another 4 different apps. Obviously, we have effortless marketing. This is our Shopify app and WooCommerce app. In 2022, we also launched Alerter, which is account monitoring app. We have Hurricane, which is a campaign performance app. And in 2023, which is relatively new now, we launched Media Plus, which is account creation and account founding app. So whatever took us a long time before, we can do much faster now, and this gives us a lot of confidence on the company ability now to grow much quicker and basically to scale up everything that we are doing. Another interesting thing that the company is doing is that we are implementing vertical integration strategy. So if historically the company knew how to provide technology solution around feed creation and optimization and campaign creation and optimization, we decided that actually the media journey of a typical customer of us don't really start with the feed creation optimization or even campaign creation. Actually start way before with, let's say, account creation, account funding, maybe media research and planning. And then after the campaign is created, you would need monitoring app, you would need analytical app, you would need financial financing and budget management app. So basically, the company decided we would like to be in every single touch point across, let's say, the customer media journey and basically supply value over there. And that strategy exactly proving itself. So fast forward, we already have under the Adcore Marketing Cloud 7 different apps. Media Blast, which is the newest addition to the cloud. It's basically allow client do-it-yourself account opening and account founding a tool, aiming more for, I would say, small business type of and small agencies type of businesses, mainly in emerging markets, but not only there. A very interesting app that we started to see a lot of, let's say, traction over there, and it's already generated revenue for us. Effortless marketing, account creation app, both for Shopify and WooCommerce. Feeditor, one of the flagship app for feed optimization. Views, the first apps that we developed for feed for campaign creation. Alerter, account monitoring, and soon we're going to add the focus component so it's going to also have predictive analytical abilities. SamDoc, which is account, I would say, analytical tool, and Hurricane, which is basically campaign performance apps that we developed. So again, every single touch point in the user journey, now we have a solution to provide, and that's give us a lot of strength and a lot of power. And that's bring me to the company updated vision, which is basically serving as a gateway to enable multi-regional and multi-channel accessibility, connecting business and customer effortlessly. So basically the fact that the company is able to be in so many different regional locations and having a different, I would say, app and technology solution for every single touch point, that's give us a lot of power and basically ability to have like all-in-one solution for our customer. And that's also give us a lot of cross-sell and upsell opportunity for every client that we bring. So we can bring, for example, maybe client for, I don't know, the account creation and account self-founding app, and then obviously we can upscale them to another app or maybe even sell them some marketing solution or services that we can provide them. So again, the more the solutions that we have, the more services that we have, the more technology and applications that we have, there's more upsell and capability for the company. And that's actually, we already started to see this power within the company result. Q1 was very strong. Q2 2023 is yet another very strong report. And bear in mind that historically, the first part of the year in online advertising is just, let's say, a warm-up for the second part of the year, because Q3 and Q4 are supposed to be even stronger historically, and the company believes that 2023 have a potential to become a monster year for the company. So let's dive into some of the Q2 2023 report highlights. And let's start with top line, middle line numbers. So as we can see, Q2 was a very strong report for us. Top line revenue was 6.9 million Canadian dollar. That represents a 33% year-over-year growth compared to the 5.2 million that we have in the previous year. And gross profit, we saw a massive increase of 41% year-over-year to 3 million this year compared to 2.1 million in 2022. So again, very strong quarter. And as you can see from the graph, Q3 and Q4 historically supposed to be even stronger quarters for us. So if we started this the first half of the year so strong, we have a lot to expect from the second part of the year. And if we talk about quality growth KPIs, and we mentioned them across, the previous calls, then there's few KPIs that the company like to look at. The first one I would say is gross margin, and if you remember, the company is happy as long as it's within the 40 to 50% range. And Q2 2023 was 43%. So it's exactly where the company anticipated to be, and we was very happy for it. And yet again, 41% in gross profit growth. That's very impressive as well. And again, another let's say quality KPI for us is the revenue we can generate from North America, which is strategic market for us. And over there we see the same trend of growth, like a continuous. So 16% year-over-year growth in North America, and we believe we can even be a bit more aggressive over there in the second part of the year. If we discuss Amphy, and we discuss a bit the monthly average burn rate for Amphy, so we can clearly see it's went down a lot. So for between let's say Q1 2023, which was 81K, now we are sitting at 66K in Q2, and we expect to see this trend continue well into Q3 and Q4 as well. So we are doing a lot of effort to be a more efficient operation in Amphy, and it's already bearing fruit. The peak was 120K, basically monthly burns that we had in Q1 2022. And since then, we managed to cut it in more than 50%, which is impressive. And on the flip side, on the positive side, you can see the same trends that we see on Amphy, let's say, site and blog video is continue. So Q1, we saw 48 average monthly visitor, and we almost double it up now in Q2 2023 to almost 100K. And we anticipate that Q3, this trend gonna continue as well. So again, we are burning less cash, and we see like a more, I would say, interest within the Amphy platform, which is, I think it's a positive signs for us. So just to ramp up, the highlights of Q2 numbers. Revenue grew 33% year-over-year. Gross profit 41% year-over-year growth. EMEA revenue grew by an impressive 50% year-over-year. North America revenue grew 16% year-over-year. And even APAC, that if you remember was declined actually in 2022, is now back on a growth trend and basically growing 29%. So we see growth grow across the board in every single region that the company is operating. Talk a bit about the share price, and basically, so the current share price is around 20 cents. And obviously, if you look at comparable, we believe that the share is fairly undervalued. And the company, that's why we continue to buy shares as well. until we see a very strong uplift in the stock. And NCIB, we purchased in Q2 almost 300,000 shares for cancellation. And the company invested in this buyback plan almost 67,000 Canadian dollar. And obviously, we're going to continue to do so as long as we think that the share price is undervalued. So in the beginning of the year, we talk about, the company, I would say, high-level targets for 2023. So the first target that we mentioned is maintain strong balance sheet with focus on increasing cash reserve. So I think Yatir can touch it a bit on his report, on his data, but cash flow is improving a lot, operation profit loss is improving, and we definitely think that we are on the right trend, and the company expect for sure Q4 2023 to be a positive quarter, both in cash flow and operational profit, but hopefully it can happen even earlier in Q3, but stay tuned. So I think over there, we definitely see a positive momentum, obviously top line, bottom line, but also bottom line numbers are improving. Second KPI or target is keep the gross margin within the 40% to 50% range. So yet another checked 43%. Third goal is achieve a dual-digit growth in revenue, gross profit, and operation profit. So 33% growth in revenue, 41% growth in gross profit, and operation profit improve in more than 30%. So I think loss improve. So I think we are definitely in the right direction. Expand our global footprint in North America. Yet again, we see this region is continuing to grow year over year, and also quarter over quarter. Number 5 is strengthening the strategic partnership that drive mutual growth and market share. So the company recently was named as Microsoft Advertising Channel Partner of the Year, and obviously channel partner in EMEA. And then we recently also announced a partnership that we have with Amazon Advertising, and also the company become a preferred partner of Criteo in Israel, and hopefully it's going to be follow up with other markets as well. So we are definitely moving in the right direction, and obviously invest in R&D. And again, you see there's a lot going on, both on Amphy, that we have a brand new brand site, website with more focus on work-related learning courses, and obviously with AMC that we recently launched another app, the Media Blast app. So yet again, we are moving actually and accelerating our R&D efforts. Okay, I think that's was my remarks for today. So we covered a lot. We talk about high-level strategy changes that we've seen within our industry that obviously affect the company and actually represent a massive opportunity for us to act as the gateway in the media. The fact that the company is accelerating, whatever took us a decade to achieve, now we can literally achieve it within 1 year or 2 years. So that's amazing. That means we can achieve much more and grow much faster. And we already started to see that within the results, so the company have a more holistic approach. We understand what is our value proposition within the market, and basically this is starting to bear fruit, and I think the reports will speak for themselves. And I think next is Yatir.
Thank you, Omri, and good morning, everyone. Second, I will share my screen here. I would like to present a clear and comprehensive overview of our second quarter financial results, highlighting both GAAP and non-GAAP metrics, all denominated in Canadian dollars. Despite facing a difficult business environment, our team performed well in the second quarter, maintaining the same positive momentum we experienced in the first quarter this year. As I mentioned in the last call, since mid-2021, we've strategically focused on higher margin revenue streams and building relationship with scalable, resilient clients. This approach has enhanced our business sustainability and improved our long-term profitability. Now let's dive into details. For the 3 months ended June 30, 2023, we delivered revenue of $6.9 million compared to $5.2 million year over year, an increase of $1.7 million or 33%. We are delighted to have achieved the upper range of our projections for the second quarter. Gross profit was $3 million compared to $2.1 million, an increase of $900,000 or 41%. This quarter, gross margin was 43% compared to 40% in the same period last year. We kept the target range of gross profit between 40% and 45%, and we are feeling very comfortable, as Omri mentioned before. As for operational expenses, R&D expenses were $0.4 million or 6% of revenues compared to $0.4 million or 8% year over year. Sales and marketing and general and administrative expenses were $3 million or 43% of revenues compared to $2.3 million or 44% of revenues year over year. SG&A expenses increased mainly due to partnerships expansion and marketing expenses. Operating loss was $0.4 million compared to an operating loss of $0.6 million. This decrease in loss was mainly driven by the increase in revenues. Net loss was $0.5 million compared to a loss of $1.2 million year over year. This slide, we will discuss the total revenue, and as you can see on the left wing of the slide, we went up by 33% year over year, on the second quarter of 2023 compared to the same period last year. And on the right wing of this slide, you can see the growth for the first 6 months of this year by 38% compared to the same period last year. As for geo revenue breakdown, as you can see, EMEA and APAC showed the most growth year over year. EMEA grew by 50%, APAC grew by 29%, and North America grew by 16%. We continue to observe strong momentum and notable expansion in our partners' plan. Now, let's discuss about net cash used in operating activities. In the 3 months ending June 30, 2023, the company utilized $0.4 million in net cash for operating activities only, a notable decrease from the $1.3 million used during the same period last year. This positive shift can be attributed to the team's diligent efforts in one, enhancing our collections from clients, and number 2, reducing vendor payments and securing improved terms with existing suppliers. In terms of financial position, we ended Q2 with cash and cash equivalents of $6.2 million as of June 30, 2023, compared to $8.8 million at December 31st, 2022. Total working capital of $7.8 million compared to $9.2 million at December 31st, 2022, a decrease of $1.4 million or 16%. The decrease in cash is mainly attributed to, first of all, media payments related to the fourth quarter of 2022, purchasing shares through the NCIB plan, as Omri mentioned before, the intensive investment in Amphy, and expanding our partnerships plan. We anticipate reducing our cash expenditure in operating activities and increasing our cash and cash equivalents in the later half of 2023 compared to 2022. This expectation is based on increased demand for the company's products and enhanced profitability. We still hold debt-free position, and the company continues to be debt-free for the future scene. Adjusted EBITDA. Our quarterly non-GAAP results reflect adjustment for the following items. Depreciation and amortization totaled $201,000. Share-based payment totaled 126,000. Other non-operational items, 191,000. And for the 3 months ended June 30, 2023, adjusted EBITDA was 112,000 compared to a loss of 30,000 for the same period last year. Adjusted EBITDA for the EdTech activity was 337,000 in the same period. Thank you, everyone. And with that, I will return the call back to Kovi.
Thank you, Yatir. We're now going to be heading into some Q&A. These are some pre-sent in questions, and I will go ahead and read them. I'll read them to Mr. Omri Brill, and then we'll take it from there. So starting number one, does the company expect to be profitable by Q4? If not, when?
Yes, so I also already mentioned it in my opening remarks. The short answer is yes, and hopefully we can achieve it even before that in Q3. But I think like we can definitely see the trend. The company, let's say, loss is narrowing or shrinking, and the company has become more efficient and more profitable. And with like the historical momentum that online advertising have in the second part of the year, then for sure we believe they can be profitable in Q4 and hopefully even before.
Okay, great. Do you anticipate any M&A activity in 2023 to spur growth?
So the market condition is still very much challenging. So I would say never say never, but if we're talking about M&As that we can use maybe some of our shares as capitals, then maybe yes. But if that means that we need now to allocate our own cash for it, then maybe I think it's too early. So it's depend. That's the honest question.
If the economy heads towards a recession, how big of an impact will this have on your business?
It's a good question. We're in recession, I would say, for the past year and a half now, and we're still waiting for him in a sense. So hopefully it's not going to come. But I think like up until now, obviously we had COVID and post-COVID effect, and obviously the interest rate is going up in everywhere in the world. So there's obviously a lot of, I would say, changes within the economy, and market conditions are anything but normal. But I would say even under this type of condition, the company is being able to outperform our original expectation, and so very strong start of the year of 2023. So I would say for now we don't anticipate any I would say any negative business condition more than what we see up until now. Hopefully we can see some positive business condition moving forward, but with the current business condition, the company expect to have a very strong second part of the year as well. That's that's the company estimation.
Are you planning to expand to any new geographic areas?
It's a good question. I think like I already touched it a bit in my remarks, that we are happy with our current geo present. Like we are literally, for a company in Adcore size, are very well spread. We're in Tel Aviv, Israel. That's the headquarters of obviously Canada, which is where we are listed as well. We have another branch now in the US as well. Melbourne, Australia, two offices in a Greater China region. So I think like we might as well focus in what we have and making the most out of it. So I don't see us opening any new office anytime soon. But again, that's for 2023.
Great. The next question is, will you maximize your NCIB allowance?
Yatir, maybe you would like to answer this one?
Yes, I will take it. We are already maximizing the program's potential. So this is a pretty straightforward answer.
Okay. Will GMs continue to improve, and what's the long-term target?
Yeah, I think like we mentioned it before, like we happy as long as it's in the gross margin are within the 40% to 50%, and Q2 it was 43%. So I think like, yeah, we feel comfortable where we are today. Obviously, if it can be more even nearing 50%, this could be even better for the company. But as long that we are within this range, we are happy with the results.
EMEA growth was very strong. Do you expect this to continue for the year?
It's a good question. EMEA is outperforming in terms of market, for the past, I would say, 12 months or so, which is encouraging. But I think like the company is lucky enough to be very well spread, and I think like revenue coming, I think almost 38 or 7% from APAC and EMEA, and then the rest coming from North America. So even if one market for whatever reason is started to slow down, we still have two other markets that can take its place. So I think like, yes, EMEA is doing great. We expect it to continue doing good, but even if EMEA for whatever reason gonna start to slow down, we are still lucky to have APAC in North America to take its place as the leading horse,
Great. What was the biggest driver in the 70% reduction in cash burn for the quarter?
Yatir?
Yeah, I will take it. So the primary reason for the cash reduction is due to media payments made in early Q1 2023, media payments related to the activity in the fourth quarter of 2022. Other explanations related, as I mentioned before, to the purchasing shares under the NCIB, the investment in Amphy, and of course the expansion of our partnerships plan.
Yeah, I would add to what Yatir is just says, that obviously, in a sense, the cash that we are losing in Q1, which is related to Q4 the last year, we should earn it back in the Q4 of this year, in a sense.
What was Amphy's contribution and impact in the quarter?
Yatir?
Yeah, Amphy contributed like 21,000 to the company's total revenue this quarter, and the company invested 236,000 on Amphy's project. So this is on the level of the revenue and on the level of the expenses.
Okay.
And
I would add that also for Amphy, historically, the quarter four is a stronger quarter as well. So even for Amphy, the second part of the year should look much better, and we are in the projection of lowering the burn rate over there as well. So more revenue and less burn rate is obviously good news for Amphy and for the company as well.
how should investors evaluate the company's result throughout the year, given industry seasonality?
Yeah. So we talk about seasonality a lot. Like in a sense, what you can think on online advertising, that literally the year is building up quarter over quarter. So historically, Q1 is the slowest month of the year. People spend all the money during the holiday season. It's winter, there's not a lot of activity going on, so there's not a lot of spending. So that's historically the slowest quarter. And then Q2 started to pick up. It's already spring, so we have the spring break and people are starting home renovation and maybe some real estate related activities. So we see more momentum in Q2. Q3 is even stronger. It's already summer, so we have all the summer breaks, travel related spends. There's more activity. People are outside. People are enjoying themselves. So obviously Q3 is even stronger. And then to finish the year with a bang, like Q4 is obviously the stronger months of the year with holiday season and all the holiday related expenses. So Q1, Q2, Q3, Q4, very simple.
Great. And that completes our Q&A section. So thank you everyone who sent in your questions. And that will conclude today's call. So thank you very much for joining in and have a great day.
Great. Thank you guys. Thanks Kovi for the hosting, and thanks Yatir for your remarks on the financial report. And again, thanks for everybody that joined us today.